From 2020 through 2024, the equity market operated like a casino where nearly every table paid out. During this period, more than 90% of S&P 500 companies delivered positive annualized returns. Simply putting chips on the table worked. This environment rewarded extreme risk. Retail investors directed capital towards speculative tech stocks, crypto tokens, and high-interest consumer goods, rarely facing immediate consequences for a lack of research. The macro environment for 2026 has shifted. Real U.S. GDP growth is projected to slow to 1.8%. At the same time, inflation has established a higher baseline, while underemployment has risen to 8.7%, its steepest increase since the pandemic. This consumer debt chart shows the residual damage of that speculative era. More than 60% of buy now, pay later users currently hold multiple simultaneous loans. These borrowers are carrying higher balances on other credit lines, suggesting they are using new debt to service existing obligations. As these personal budgets tighten, the fear of making a wrong financial move has intensified. To compensate, investors are consuming a non-stop stream of news, social media forecasts, and technical indicators. This surge in data consumption leads to analysis paralysis, a state where the inability to filter information prevents any actionable decision-making. The speculative playbook of the last 5 years is now a liability. To protect wealth in 2026, the gambler's mentality must be replaced with an investor's focus on execution and high-probability outcomes. While the broader economy is slowing, corporate revenue is still projected to outpace GDP. This is the growth gap. It exists because corporate revenue tracks nominal GDP, including inflation, rather than inflation-adjusted real GDP. Additionally, 30% of S&P 500 revenues come from outside the U.S., tapping into faster-growing foreign demand even as the domestic economy cools. Artificial intelligence drives this margin growth. In 2026, AI functions as a corporate cost-cutting engine. Labor currently accounts for roughly 55% of total business costs. Corporations are using AI to automate workflows and reduce headcount, with 70% of recent job cuts framed as efficiency initiatives. If AI reduces labor's share of costs by just 5%, it would generate over $1 trillion in annual labor savings for those companies. Corporate profitability is decoupling from broad economic health. An investor's task is now to identify companies using technology to protect their margins, rather than chasing those hoping for broad market growth. Even with the right strategy, investors lose capital daily through invisible micro-frictions. This visualization shows an automated market maker, or AMM, pool on a decentralized exchange. Asset prices are determined mathematically based on the ratio of tokens in a pool. When a large trade hits a shallow pool, it tilts that ratio, forcing execution at a worse price. This difference is technical slippage. Setting a high slippage tolerance acts as a beacon for predatory bots. They execute a sandwich attack, buying the asset a millisecond before the user and selling it immediately after. The bot extracts a risk-free profit, leaving the user with significantly fewer tokens. There is also social friction. The wealth gap among friends often creates a psychological pressure to keep up. This results in financially incompatible friendships, where individuals spend beyond their means on expensive dinners or vacations just to maintain social proximity. These technical and social frictions act as a compounding tax on a portfolio. Without discipline, they can drain capital as effectively as a market crash. The ultimate counter to the gambler's mindset is the mathematical futility of trying to time the market's peaks and valleys. Consider a 20-year case study ending in December 2024. 2 investors each contribute $10,000 annually to the S&P 500 index of leading U.S. companies. Investor A has perfect luck, hitting the absolute market bottom every single year. Their $200,000 principal grows to over $800,000, yielding a 12.25% average return. Investor B has the worst luck possible, buying at the absolute market peak every year. Yet their portfolio still grows to over $600,000, returning 10.54% annually. Over long periods, 100% of 10-year windows in the S&P 500 have been positive. Because the market trends upward over decades, simply staying invested absorbs the penalty of poor timing. Time in the market neutralizes the risk of bad timing. Consistent, disciplined participation delivers outcomes that speculative gambling cannot match. In 2026, the market is defined by high dispersion, meaning the performance gap between the best and worst assets is widening. Careful selection is now mandatory. The first rule is to rethink diversification. Because stocks and bonds are moving in tandem more frequently, true diversification requires high-quality fixed income to secure durable yields that can withstand market volatility. Second, optimize execution. Separate your research from your trading to prevent analysis paralysis, and use conservative slippage settings to protect your capital from predatory bots. Third, protect your boundaries. Establish clear budgetary limits in your social life, and aggressively reject high-interest, unsecured bet traps like buy now, pay later loans. The 2026 market is a precision mechanism. It rewards those who prioritize discipline, patience, and execution, marking the end of the gambler's era.